Hello, everyone. Welcome to the Monday Morning Podcast. This is the second week of our gold block. Last week we had Shay Russell on. This week we've got Brian Chu of Gold Stock Pro on. And next week we have Tekoa da Silva, a big name in gold as well. The Federal Reserve has just had its meeting, virtual though it may be, at Jackson Hole. And we talked to Brian Chu about what that means for the gold price. Here's me and Brian. Hey, Brian, great to have you back to talk about gold again. How are you today?
I'm doing all right, Lockie. And yeah, it looks like it's pretty good weather where you are. Is that right?
Oh, it's actually beautiful down here in Melbourne and things are looking up. So I was just going to pick your brain on a few gold topics today. We've just had the Jackson Hole meeting in the US. The Fed is pretty much playing the same tune that it's played for a long time, particularly Jerome Powell. And not much has changed. You know, it's sort of the market moved up after the meeting, and that was sort of indicating to me that the rates will stay low for a persistent period of time. How does this play into the gold price, Brian?
Well, I guess if you look at the movements in the price of gold in US trading last Friday, it closed up $20 US dollars higher at about $18.16. And today, right now, as we are talking, on Monday afternoon, just after the market close, it's at 18.12 US dollars an ounce. In Australian dollar terms, the Australian dollar has strengthened relative to the US dollar quite significantly, and it's above 73 US cents. So we are clocking about 24.80 Australian dollars an ounce for gold. So I guess there is an offsetting effect in the Jackson Hole meeting that the Federal Reserve, once again, as you pointed out correctly, they're playing the same game. It's talk things up about tapering, leading up to the Federal Reserve meetings, scare the investors into a taper tantrum, bash the price of gold and silver and a couple of commodities down. Then afterwards, in the press conferences, tell people, well, you know, we think the economy is growing. We'll probably taper later on, but we're not going to talk about when. And as a result, the investors will start reversing all their taper tantrum trades. So I guess there's a rinse and repeat, but there's a niggling thought in the back of my mind that there's increasing complacency among investors, and there could just be one nasty day when the Federal Reserve decides maybe we will act on it and catch everyone by surprise. So that could play nicely into the hands of gold investors. There may be a short period of pain should a shock event like that happen, because everything is going to go down. But if past is an indicator of the future, not that history rhymes and not that history repeats, but look at what happened in February and March last year, when everything fell down, but gold actually was the first to bounce up on the 16th of March, a week ahead of everyone else.
Well, that's a fascinating sort of time capsule opinion you've got there, taking us back to February 2020. I want to pivot now to some comments you've got about the current state of gold mining in Australia. What I'm noticing is a lot of these gold miners have significantly elevated margins, at least historically speaking, and the differential between their all-in sustaining cost and the actual price of gold in Aussie dollars is still quite large. So what are your thoughts on this, Brian?
So from what you say, given that there is a increased margin between the price that our gold producers are selling into the market and how much they're spending getting the gold out of the ground, we are in a period where there is a sweet spot. but there is some headwinds, and I need to be realistic about this. There are headwinds thanks to the politicization of our state governments, where premiers are now hoping to score points off each other, saying how bad the other state is in managing their the number of cases and hospitalizations from the virus, and they're closing their borders down. Western Australia has decided to basically take it one step further, and it's affecting the mining industry in there. So while we are actually watching higher margins for these gold producers, we will actually experience a 1 or 2 quarters perhaps where costs are going to be a little higher and production is going to be a little lower. And I think that may have been the reason why gold producers have been are still somewhat down relative to the price of gold. As you can see, the gold ASX gold index, it's about 6,450, 6,500 today, and it's been down relatively compared to how gold is actually now at levels near early this year. And back when that was happening, our gold index was well over 7,000. So it is cheaper at the moment, but investors I think are a bit cautious because they expect there may be a speed bump for some of these gold producers. As for explorers, I think a lot of wind has been taken out of them, and I am noticing some of the better explorers have jumped quite significantly in the last week. 1 or 2 may have jumped because of recommendations I've made to new Gold Stock Pro subscribers and those who joined the Gold Digger Summit. But there are others which I did not recommend, and they're going up 10, 12% today. So I think we may actually be seeing them round the bottom. And I certainly hope that's the case if the central banks continue to just
do what they've always done.
Yeah, which is what they've always been doing. And I think it will be a couple of months before they'll start talking about tapering and scaring people again.
Well, you mentioned a sort of labor crunch there in the offing, particularly for WA-based gold companies. I was sort of a bit curious. Maybe you've got a bit of a grip on this. How much labor is involved in, say, a gold producer versus a gold developer or a gold explorer? Which is more sort of like pound for pound, the more labor intensive? I was just curious off the top of my head.
Well, I'll be honest with you on this, Lockie, and to viewers, I'm talking off the top of my head on this one, and it's based more on logic rather than hard statistics. So I'll need to dig in a bit deeper if I'm going to provide you with more solid numbers. But my understanding is with explorer companies, some explorer companies can work off a staff of maybe you have the board, 4 or 5 board directors, executive management. Some executive management could be contractors, and people on the ground doing the work. You could have as little as even 5 people on the ground, surveyors,
Geologists,
people with metal detectors. As the operations get a bit bigger, with developers where you're building something, you may have to hire contract miners who are driving trucks, people who are building sites. So that could be 100, 150, depending on the scale of the mine. With producers, you could have significant headcounts of 300, 400 in a single mine operation, because you need people operating the machinery. You need quite a number of people manning the processing plants, quality assurance, and you also have to have human resources, corporate finance administration teams. So the large producers are the ones who are facing a bit of a crunch in terms of the on-the-ground management of their mine sites. Some of their staff, they are facing short staffing. Developers and explorers, probably not so much, but there is actually a lot of competition between various mining companies for contract staff to work on the ground. So even the developers are probably facing a bit of a squeeze. And explorers, I think the smaller ones would be fine. The only thing that they're held up on, as I understand from what Shay's been talking about, she's got insider knowledge on the labs. The explorers are more keen on the lab results on their drill samples.
Yeah. Well, I mean, all of these are sort of important things to know if you were to go about valuing a gold company, where it is now, where it could go in the future. And I know a lot goes into it, but I was hoping you could give us a sort of a quick version of the way you go about valuing gold companies, because I think this will be really interesting for people who are interested in gold companies in Australia.
Yep, my pleasure to talk about this. So I developed, you could say, standing on the shoulders of giants in the past, and I've extended the methodology that they have used in industry, which are multiples on production or multiples on resources and reserves. So for producers, I've added on top of a multiple on producer is that I adjust the production based on the all-in sustaining costs. My belief is that a higher cost miner is going to, even if the higher cost miner produces more than a lower cost miner, what matters is how much it costs them to get the gold out of the ground. If they spend a lot more, it's because they're going through more rocks to get the same amount of gold. So I level the playing field that way. And I compare that against the margin in which they are able to sell their gold on in excess of what they produce. So from there, I get the adjusted production divided by their profit margin. This gives me a enterprise value multiple similar to what industry would use for like a price to earnings ratio or an enterprise value to EBITDA or type of multiple. So that's how I use it for producers. And based on my historical data, which I have hand collected for producers in Australia, I come up with suitable multiple ranges for large, junior, and mid-tier producers. And that allows me to get an idea of what the fair value should be. And I compare that against what the price is at the moment to see whether I'm getting good value or not so good value on the producers. On the developer and explorer side, I look at the amount of resources and reserves they have in the ground. But on top of that, similar to producers where I adjusted for costs, I adjust the resources based on the grade of the resources. Because again, the same argument is a lower grade deposit means you got to crunch through more rocks to get the same ounce of gold out, and that's going to cost more. So I adjust the grade and then come up with a enterprise value multiple for that and compare it against other peer companies and see which one is better value. So I use that approach to select my desirable explorers that I put on the short list to recommend to my subscribers.
Well, it's great you got a sort of rigorous rubric to work with there, Brian. I just want to ask you one final thing today, and it's this, is if you could say one thing to prospective gold investors right now, what would you say?
Well, right now, we have seen the price of gold recover after having a rather protracted decline. And while gold stocks are trading lower, even as we saw the gold price recover, I want you to understand that the tailwinds of the weaker economy, delayed tapering of quantitative easing will probably be supportive of the price of gold and silver. And with better operational capabilities of the companies in Australia, they have slimmed down and so they have trimmed their fat from the past couple of years. They are actually run better. So this would be a good time to come in and start accumulating. I do understand that there are talks between people who are in the technical side, and they say that it may take a little while longer for gold to really rally just like it did in 2019. If we hold out and these people are correct and gold is going to take a little longer to rally, it means that don't jump in head first, but start accumulating and getting into the action, because once people pick up on this and the price of gold rallies, it will be too late for you to come in and grab those bargains.
Okay, well, that would be pretty exciting for a lot of people who are into gold out there. There are, of course, risks associated with this, but I would also just say that history is a pretty good guide. I mean, if you go back to the 70s and 80s, what happened there, it was pretty astounding for gold. And if you look at the historical charts, there's sort of, you can see why a lot of gold investors see a lot of headroom on the charts in the future. So I want to finally thank you for your time today, Brian. I had a lot of fun as always. We always keep up the chat in the background, even when we're not recording. So thank you very much, Brian.
Yeah, my pleasure, Lockie.
Well, that was a great chat I just had with Brian Chu of Goldstock Pro. Next week, remember, we've got Takoa Da Silva, a famous gold investor, on. That's going to be super exciting. So I can't wait to share that with you. As always, like, subscribe, get in touch. We'd love to hear from you.